In this video, I'm going to go over how I use my stock portfolio to effectively fund my real estate deals. For those of you who are new to the channel, my name is Jack Duffley and I'm a real estate attorney and investor. And if you get something out of this video, if you like it, definitely hit that like button and subscribe. I put out new videos every single week as they have to do with personal finance, so I'd very much appreciate that. Anyways, here's what I do. So here is me up top. And I make money from my job and then it has to go somewhere. If it's not being used to pay down debt or towards actually spending it on whatever we're doing in a given week, it's going towards my investment portfolio. And right now, pretty much all of my income, after I pay all those expenses and debts, goes towards my stock portfolio. So we'll go ahead and draw this big circle here. This will be my stock portfolio. I know that is not very circular, but oh well, you get the idea. There are a bunch of different stocks in here, some funds and whatever, but mostly individual stocks, and I have a good amount of index funds in my retirement accounts, but this is really more on the taxable side. So it's a lot of individual stocks with a few sort of index funds mixed in. So as I get my paycheck, money is going into my stock portfolio and it's generally being invested. I like to try and remain fully invested, but I'm a real estate investor at heart. And unfortunately, at least given my deal flow, it's not all that great. So you spend a lot of time saving up money as a real estate investor, unless you're some baller who's running a fund and you're taking other people's money using tons of debt. And sure, there are plenty of ways to use debt effectively, but I'm not going that crazy. I still have a day job and right now the supply is very tight. So it can take a while between real estate deals right now, especially as prices continue to just go up and up and up in pretty much every market. But anyways, I'm investing most of my money into stocks, or at least all of my investable cash is going into my stock account. And this is generally fully invested. There's not a bunch of cash sitting here. Let's say a beautiful, juicy real estate deal comes up and I really want to buy it. We'll draw this house as best as I can on this board. So I don't know, we'll just say RE for real estate. Real estate deal pops up. I really want to buy this thing, but oh no, all of my money is tied up in stocks. I don't have the cash pile that could be used to go for this investment, whether it be to fund down payment, actually make an all cash purchase, to fund the rehab, whatever it is, you're going to need some sort of cash, whether it's your money or someone else's, to actually buy the property. And we'll say I can't actually raise enough money from other people to actually buy this property. So what I do, and I actually did this on the property that I'm filming from right now, and I plan to do it on my next deal, is I actually will go and take out a loan against my stocks. I take a margin loan out. And I use that margin to pay for the down payment or whatever it is for this real estate deal. So now all of a sudden I have cash. So this money goes from here via margin. That might be a little bit small, but you get the idea. I'm taking out debt against my stocks to then buy the real estate. And the cool thing about the margin debt, at least that I have access to right now with M1 Finance, I always include that affiliate link in the description below, is I can get it at 2% right now. Of course, I could go up because it's a variable rate loan and there's plenty of risks with that. We'll get to risks in a second. But I'm taking out debt at a very low rate against my stocks that can be used to go and buy my real estate purchase. Then I'm gonna go through with this real estate deal. I'll get a tenant in place, I'll fix it up, whatever it is. I'm actually gonna go through with the deal. And then once it's kind of stabilized, then maybe I can actually take out a refinance against this property and use that to pay back this margin. But in the event that I can't do that or it doesn't make a lot of sense to, I can also continue to just pay my salary towards this margin and kind of stop buying stocks for a second and pay down this margin, get back to that sort of zero state where I don't have any margin. So it'd either be from my salary or from something like a refinance. I'll go ahead and draw this arrow here just so that's clear. Money from the real estate deal, be it from rent or a refinance, and then salary that I'm bringing in is going towards paying down that margin and getting back to that sort of base state. And then we can go ahead and wipe away this margin after however many months, maybe even longer, depending on how hefty this deal is and how much I'm making, of course. Then all of a sudden the margin's gone and we go back to square one, only now I have a real estate deal that's throwing off more cash. Then we can actually use that cash to actually invest in more stocks, depending on how juicy the cash flow is on this deal. Now let's talk about the pros and cons of this strategy. The obvious pro is that I can stay invested in stocks while still having money to invest in real estate. So it's not as though I have to pick one over the other. I can actually do both at the same time. And that's a really great advantage, at least in my view, because one, I like the process of investing in stocks and looking at companies and trying to pick stocks that will do well over the long term. Whether I'm an amazing stock picker or not, I don't know, but we'll see what happens over the long term. But even if I was using just all index funds, same sort of premise. I'm constantly investing. I feel like I'm putting my money to work and I should do better over the long term when I'm investing my cash in quality assets. And then I'm not stuck with the dilemma of coming across some deal in the stock market that I really want to take advantage of, or if I was doing dollar cost averaging into an index, and I don't have to second guess myself in setting aside cash and not putting it into the market or into a particular stock and letting it work over the long term. And that's something that I really value right now, in that my portfolio really isn't all of that big in the grand scheme of things. I want it to be much bigger than it is now, so I'd rather just continue to funnel money into it and continue to grow it as fast as I can. But there are some obvious cons with this strategy as well. Now, there was margin debt here, but I erased it away, so it's all gone now. But if I did still have margin debt, and that means that I'm open to getting margin called, meaning that if my stock values fall quick enough while I have this margin open, there's a chance my brokerage could trigger a margin call against my portfolio, force me to sell my stocks to pay back the margin debt. And that would mean that I wouldn't get to choose whether or not to keep those stocks. I'd have to sell them at whatever the price is. And chances are those stocks would look pretty cheap since they would have taken a dive recently. And as long as nothing fundamentally changed, then I would want to hold on to those stocks for the long term. So I'm opening myself up to that risk by taking out that margin loan, even if it is for a relatively short period of time. And then there's also the chance that the real estate deal goes south and I lose my money that way. And I'm going to have to make up for the margin through some other means, like paying it down with my salary. So at a certain point, this is going to be a lot more difficult to do, at least just paying it down with salary, because the margin loans, the real estate deals, the stock portfolio itself, it'll be a lot bigger than my ability to simply replenish it and pay down the margin that way. Unless I can get some of that Graham Stephan YouTube money going, and then I could use my fatter salary to pay down the margin loan or invest in stocks more aggressively. I'd appreciate it if you subscribed. So all in all, this is a riskier strategy. Whenever you're adding debt into any equation, you're adding risk to the table, because I now would have an obligation to pay another person. And if I can't pay that person, then I'm going to be in trouble in some other way, whether it be liquidating my stocks or wrecking my credit or both, or just doing all sorts of nasty things. So it's definitely a balancing act, and I have to be careful with it. Now, I'm not suggesting that you do this for your own portfolio, since it's up for you to decide. It's up to your own risk preferences, your own risk tolerance. I don't know what your situation is, and if you need help, go talk with a licensed financial professional. I am not one of those. So this is the strategy I plan to use for my next real estate deal. Of course, these circumstances might change, or the deal might call for some different strategy, in which case I would use a different strategy. And it's not as though this is the only thing I can do. It's just another tool in the tool belt. But if you guys like this video, definitely like, comment, subscribe, all of that great stuff, and check out the affiliate links in the description below. But until next time, take care.